Indian markets have been making new highs. Over the last 1 year, as of September 27, 2024, the Sensex has delivered 30.37% returns, the BSE Mid Cap Index 54.44%, and the BSE Small Cap Index 54.11%. Now, amidst this, many stocks have been making new highs as well. However, the recent flare-up between Israel and Iran can spoil the party. After touching a high of 85,836 on 26 September, the Sensex has fallen to 82,487 on 3rd October. So, amid this, we decided to do a quick status check of the stocks at all-time highs to assess which ones may be ripe for a correction and which ones are in comparatively safer zone. Hello and welcome to ET Money's YouTube channel. If you invest in stocks and have a stocks portfolio, this video is going to be immensely helpful to you. Not only will you get to know which stocks are currently in the danger zone, but also which ones are attractively priced in spite of being at highs. But before I start, a quick update. We recently launched the stock discovery feature on the ET Money app. Now with just one tap, you can see every detail about a stock and its underlying business, plus a lot more. So do check it out. So to look for the stocks at all-time highs, we consider the BSE 500 group of stocks. Now the BSE 500 has stocks from large, mid and small cap space. So it provides a comprehensive picture of the stock market. Then we filtered out stocks that are within 10% of their all-time high prices. Now this gave us a list of as many as 174 stocks. So out of 499 stocks in the BSE 500, 35% of the stocks are currently around their lifetime highs. We wanted to check the extent of overvaluation in these stocks. For that, we applied 3 valuation measures: PE to median PE, PB to median PB, and PEG. Let's see what results we got on applying these measures. The PE, or the price to earnings ratio, is a popular valuation measure. It is derived by dividing the stock's price by the earnings per share. But the PE ratio in itself doesn't tell us whether a stock is cheap or expensive. So, to make sense of it, it has to be put into perspective. Now, one way of doing so is to compare a stock's PE with its historical median. If a stock is below its historical median PE, that indicates a bargain. The farther away a stock is from its median PE, the more overvalued it is. In other words, if the PE to median PE ratio of a stock is less than 1, that indicates undervaluation and vice versa. Here, we have considered the 5-year median. So, let's check the distribution of the 174 stocks at all-time highs based on this valuation measure. Now, 17 stocks are currently below their historic PE median, and 149 stocks are above their historic median PEs. 8 stocks don't have valid PE data, so they have been excluded. Now, of the 149 stocks, 119 stocks have a PE to median PE ratio between 1 and 2, and 30 stocks have a ratio of over 2. Now, these 30 stocks can be considered extremely overvalued. On your screen is the list of these 30 extremely overvalued stocks. The top stocks in this list are Century Textiles, Vedanta, MCX, PCBL, and Suven Pharma. Their PE to median PE ratio ranges from 3.8 to 9.1. Now, all these stocks have delivered good returns over the last 1 year, which has attributed to their overvaluation. Next, let's see the 17 stocks that still offer valuation comfort in spite of their run-up. The top names in this list are Bajaj Finance, Maruti, RR Cable, Dr. Reddy's Labs, and ICICI Securities. Their PE to median PE ratio ranges from just 0.7 to 0.8. Now, these stocks have delivered moderate returns over the last 1 year, and that may have resulted in their being undervalued. Now, if you're wondering how these stocks are still reasonably valued in spite of being near their all-time highs, let me answer that question as well. If the rise in stock price is accompanied by a rise in earnings, the stock can continue to be reasonably priced or even attractively priced. It's when the price runs far ahead of earnings that a stock turns overvalued. So, in spite of being at highs, these 17 stocks are not expensive as far as the PE to median PE metric goes. Okay, let's now assess the 174 stocks at all-time highs from the lens of the PB to median PB ratio. Now, PB stands for price to book ratio. It's also a popular valuation metric and is especially useful for asset-heavy companies and banks and finance companies. It is derived by dividing the stock price by book value per share. Like its cousin PE, it can be put into perspective, and for that, we will compare the PBs of the 174 stocks at all-time highs with their 5-year median PBs. Here's the distribution of the 174 stocks in terms of their PB to median PB ratio. Only 11 stocks are currently at a discount to their median PB and hence have a PB to median PB ratio of less than 1. 36 stocks have a ratio of over 2 and hence are in the extremely overvalued zone. Now on your screen is a list of these 36 stocks. The top names in this list are Himadri Specialty, Apar Industries, Jindal Saw, Kalyan Jewellers and TVS Holdings. Their PB to median PB ratio lie in the range of 3.8 to 6.3. And now let's see the 11 stocks that are still reasonably valued as far as this metric is concerned. The list comprises stocks like HDFC Life, FL, Bajaj Finance, HDFC Bank and Info Edge. Their PB to median PB ratio range from just 0.6 to 0.9. Finally, let's check the valuation of the 174 stocks in terms of their PEG or price to earnings growth ratio. The PEG ratio is obtained by dividing the stock's PE ratio by its earnings growth rate for a specific period. The PEG ratio is especially used for growth stocks, as such stocks tend to have high PEs and may look overvalued, yet when seen in light of their earnings growth, they may not be. A PEG of less than 1 is considered a bargain. It implies that the stock's valuation in terms of its PE is less than its earnings growth rate. So, let's assess the distribution of the 174 stocks in terms of their PEG ratios. Here, we have considered the 5-year earnings growth. 20 stocks have a PEG of less than 1, which makes their valuation reasonable. Another 31 are between 1 and 2, and 100 stocks have a PEG of over 2, which makes them extremely overvalued. Now 23 stocks don't have a valid PEG number, so they've been excluded. On your screen is the list of 25 most expensively valued stocks on the basis of this matrix. The top names in this list are HDFC Life, JSW Steel, Divi's Labs, KIMS and NTPC. Their PEG ratios range from an eye-watering 23 to 28 times. And if you are interested in reasonably valued stocks in terms of their PEG ratios, the list is on your screen now. The top names include Atham Investments, Gujarat Fluoro, Kalyan Jewellers, Lupin and Lloyds Metal. Their PEG values are between 0.1 and 0.3 only. So, these were the stocks list based on the 3 valuation metrics. Now, what if we combine 2 or more valuation measures? That would be an interesting exercise, right? So, let's find out companies whose PE to median PE, PB to median PB and PEG are all less than 1. Well, this query just gave us one answer. ICICI Securities. Alright, now let's combine the PE to median PE and the PB to median PB measures. This measure gives us 6 names, including ICICI Securities. Now, what if we combine PE to median PE and the PEG ratio? We get 3 names by combining these 2 metrics. Lastly, let's combine the PB to median PB and the PEG measures. Now, this combined measure results in just one name, which is ICICI Securities. So, this was some data on stocks at all-time highs and their valuations. Okay, so this might be too much information to absorb in a video. That's why we've also prepared a downloadable Excel with all this data. You can run your own permutation and combination on the data to filter out stocks as per your requirements. But the bigger question is what you should do if you realize that the stocks you own lies in the overvalued zone. Also, should you buy an undervalued stock when it is its all-time high? Let's answer these questions and conclude the video. So what should you do if you own a stock that is at all-time highs or even multi-year highs? Now, all-time highs or multi-year highs or 52-week highs themselves shouldn't dictate your investment choices. Rather, it's the valuation that you should be concerned about. So, if a stock has turned overvalued, you should certainly be concerned. What to do next? Find out what has resulted in run-up in the stock. Are there any business reasons behind the run-up, or is this just a bull wave that has lifted your stock too? If it is just the sentiment that has resulted in a run-up, you can think of trimming your position or even exiting the stock. However, if the run-up is due to positive development which can result in re-rating of the stock, you may want to continue to hold it. Now that's one way of looking at things. Another way is through asset allocation. If you follow a certain asset allocation, you can also rebalance your portfolio by trimming your position in overvalued stocks. Now, what about fresh investments in stocks at all-time highs? Again, an all-time high price itself shouldn't discourage you from buying a stock per se, provided the valuations are sound and the fundamentals are good. But if you're too concerned about life highs, you can also buy a stock in a staggered way or even via SIPs. Many brokers enable you to do that today. And with this, we have come to the end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.